Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Thoria and with me is Vivek Iyer. Well, Vivek, a very good afternoon to you. It's turning out to be a very good afternoon for the markets as well. Nothing to complain. It's green across the screen.
Absolutely. A little bit of cooling off from the day's highest point, especially as far as the defense pack is concerned. But we have quite a lot lined up on the show. We have two managements, very interesting interactions over there. Let's start off with the key headlines. Stocks climb on a halt in hostilities in West Asia. FMCG and auto perk up while realty and private banks sulk. Mid-caps lag.
KEC International in focus after it bags orders worth over 1,200 crore rupees for civil projects, the company's largest order in the buildings and factory segment.
Torrent Power gains after Maharashtra Electricity Regulatory Commission issues a public notice expressing satisfaction for granting approval to the company for parallel DISCOM services in Pune, Nagpur and MMR. This approval, when granted, will enable the company to act as a DISCOM in Maharashtra.
Dixon Technologies under pressure after Phillip Capital maintains sell call with a target of 9,085 rupees, flags that Dixon's largest client, Motorola, has begun outsourcing domestic volumes to Carbon.
MCX rises over 6% as UBS maintains its buy call and raises its target price to 10,000 rupees a share from 7,000 earlier, expecting new product launches to drive further growth.
Well, 25,250 thereabouts is where the Nifty is at currently. It's comfortably sitting out there. And, if the index manages to hold on to this, it'll be the second consecutive day of gains for the benchmark indices. The mid-cap end of the market is doing quite well as well, but not as well as the benchmark indices. The mid-cap index is up 0.3%. The broader markets will come up for you, the advanced decline ratio out there. We have almost 2,000 stocks advancing for 619 stocks that are declining. That will show you that the broader markets, specific stocks are doing quite well. Now, as far as sectoral indices are concerned, most of them are in the green with the exception of Nifty Realty. We have Nifty Media as well as the Nifty IT index that are leading the gains in today's trading session. But lots of individual stocks that are moving around in trade. And to highlight just those, we now have Hormaz to take us through in our special segment, Midcap Movers. Good afternoon, Hormaz.
Good afternoon, Bamakshi. And one of those days when the broader markets are not outperforming the benchmarks, but the advanced decline ratio is here to give you enough comfort. Starting off with some of the movers, then Samman Capital is the top gainer on the Nifty 500 today, 16% higher on that stock. MTNL goes one step further, now 18% higher there. Solara Active Pharma also saw a big spike after 11 a.m. and since then has been around about those 12 to 13% gains. And Endurance Technologies too having a good day at the office. Lots of brokerage notes came in earlier in the day, and MCX with a 10,000 rupee target price from UBS is now up 6%, slightly off the highs of the day though. IndiaMart after the Nuvama upgrade has seen a bit of choppy moves but still holding on to gains of around 6%. Hyundai Motors is a post-listing high for the stock and initiation from Avendus Spark earlier in the day today. So positive moves here, and Dixon of course on the sell recommendation from Phillip Capital. Some of these industrial names have done very well in today's session. Look at Bharat Bijli, 12.5% higher there. Kirloskar Brothers, a good day. Maharashtra Seamless, ITD Cementation is a new high for the stock, 5% higher there as well. Stocks doing well on the volumes front in today's trading session. Look at Welspun Corp, but of course Balaji Amines, Bazaar Style, Den Networks too, 10% higher on very strong volumes. And lastly, some of the pockets not doing well, of course it is defense. The profit booking continuing here. Garden Reach down 9% yesterday, another 5% today. Masgao Docks down 3% and Data Patterns too at the lowest point of the day. Back to you guys.
Thank you so much, Hormaz, for joining in and giving us all of those important stocks to track, especially as far as the broader end of the markets are concerned. Well, before we slip into a short break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m. Welcome back to Mid Cap Radar. Well, the first management on the show is Raymond. Remember, Raymond Realty's T3 debut is scheduled on July 1st. It plans to launch 14,000 crore rupees housing projects in FY26. We are joined by Amit Agarwal, who's the Group CFO at Raymond, to discuss more. Thank you so much, Mr. Agarwal, for joining us. Well, first up, Raymond Realty lists next Tuesday. Quite a lot of expectations from the street. Take us through the key details of that particular entity. We understand, you have almost 6 projects lined up. So what is the total GDV of those projects? What is completely belonging to the Raymond stable? And what is being done via the JDA route?
Thank you for having me on your show. Friend, look, Raymond Realty has got 2 large verticals of the business. One, the 100-acre land, which is owned by Raymond Realty, which we are developing as we speak today. Of that, 40 acres is currently under development, and the balance 60 acre would get developed over the next few years. So that is one revenue stream for the business. The second revenue stream is primarily the JDA projects, and these JDA projects, we have already signed 6 JDA projects, which is almost 14,000. So put together between the two is almost 40,000 crores of the gross development value. And between these 2 projects, as we speak today, 9,000 crore has been already launched, and another 5,000 to 6,000 crores we plan to launch in this year. So thereafter, what happens, everything keeps on getting launched one after the other years, and we continue to evaluate more and more JDA projects because the Thane land is a finite land. So in order to have a growth of the business, we continue to do JDAs in MMR region. And if I look at it, as far as the JDAs, there are enough and more opportunities coming on our way. And we have evaluated more than 600 projects in order to sign up for the 6. So we are very cautious and careful in which JDAs we want to get into and what is the right project which fits in our scheme of things and the fundamentals. That's the way the business.
Sure. Mr. Agarwal, this is Vamakshi joining in. Now, if I'm not wrong, in your outlook for FY26, you've said that you're expecting 20 to 25% growth in your booking value. So roughly back of the envelope calculation suggests that the booking value would come up to roughly 3,000 crores. So isn't this a modest, growth guidance, and I mean, just would like to understand from you, is this a function of the projects lined up, or do you see some softening of demand that is taking place?
Actually, if you ask about the demand, I think we have seen a decent demand. And even as late as in the month of June, we have seen very good bookings. Actually, what you're seeing a little bit pressure is absolutely in the top end luxury segment. If I look at the affordable luxury where we operate 99% of our business, there we have not really seen any kind of a dip in the demand. Second thing, it is the lifestyle which we sell. It is not really just an apartment. And I think that is one of the reasons when we launch our project, the day one, we get a very, very good bookings. And if you see across over the projects which we have launched so far, we have sold most of the projects anything between 65% to 97, 98%. So therefore, we have not seen any way in our projects, there is a weakness in demand. Second thing, when you're talking about a projection that we are talking about 20 to 25% growth, the fundamental reason for that is that we want to be very clear that this is a minimum which we know that we will be able to deliver. And beyond that, as we continue to launch the projects, the bookings will come. So this is the minimum, so to speak, that we are 101% assured that this is going to happen. And if you look at the demonstration of our performance between 25 revenue to 26 revenue, there's already a 46% growth. So the company has been able to demonstrate a significant growth and improvement in all across parameters.
Understood that. For the next couple of years, 50% of the annual pre-sales is targeted from JDAs. So the first question is, how do you fund these JDAs? What is the funding requirement from Raymond's end? How does the interest rate differ compared to other developers? And what does it mean for EBITDA margins? I mean, own land versus JDAs, what is the EBITDA margin differential?
Look, first of all, when we talk about, you asked 2 questions, one about the funding and about the margin. Let me talk first about the funding. If we do our JDA model is very simple mechanics where our philosophy whether it is our own land or a JDA project, is sell fast, construct fast, and collect fast. Every project in Mumbai MMR in India is on a construction link payment. So if you have sold the inventory, you are bound to get the collections. So I'll give you a simple example. On a 2,000 crore project, your peak cash funding requirement is in the range of 450 odd crores, of which the 250% of that is 225, 230 crores comes from the Raymond equity, and the 230 is a project finance debt. Project debt, we are able to get it from the various Indian banks, which they are very, very supportive. And at the end of the day, the Raymond Group has a very strong, credible history with banking relationships. And therefore, we are having no challenges in getting that funding. And that also, because we are able to complete the project in a faster pace, our peak cash requirement is on the 18th month in a cycle of 60 months. And by 32nd, 33rd month, the project starts to generate cash so that the debt starts.
And the word on the margin, sir?
Sorry?
And the word on the EBITDA margins?
So the EBITDA margin, again, for different projects, it will be different, because at the end of the day, each project will have a very different structure. There will be a different margin profile, different sharing of the land which you need to do in terms of the square feet you need to give to the tenants, in terms of the people who are there who have to give the land.
Sure.
So it will be very different. But broadly, the way we have defined is across the board, we will not be entertaining a project which will be below a 20% EBITDA margin, and all our projects should deliver minimum of 20-22% IRR.
All right. Thank you so much for that, Mr. Agarwal, for joining in with CNBC TV18. But as we slip into a very short break, here is some good news for our viewers. India's business news leader is only just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Midcap Radar on CNBC TV18. Let's shift our focus to quality power equipments. The company has announced the launch of Global Coil Factory in Maharashtra. It will address growing global demand for high voltage reactors and coil-based components. Bharti Pandian, who is the joint MD and whole-time director at Quality Power Equipments, joins us now to discuss more on this. Well, good afternoon to you, sir. First of all, congratulations on your groundbreaking ceremony. I'd first like to ask you, about the timeline of this project completion, because earlier you had indicated that this would get completed in Q2 of FY27. So, number one, is this on track, and what is the kind of capex that you have outlined for this?
Mr. Pandian, I believe you're on mute.
Good afternoon, Vamakshi. Thank you for getting in touch. Yes, we are on schedule to come in Q2 next year. We have envisaged a capex of between 125 and 150 crores, most of which is being funded through a promoter soft loan on the company at this point.
Understood that. So, what is the peak revenue potential and the peak EBITDA margin potential when you consider utilization at peak levels?
We presume the plant can deliver about 1,500 crores, give and take, and the margins for the product chosen at this moment is about 20% before tax.
All right, and your Cochin facility is also expected to come on stream in November 2025. So how quickly would you be able to ramp this up, and what is the kind of revenue contribution that you expect from this facility in FY25, whatever part it comes on stream for, and what is the kind of products that you're targeting in the Cochin facility?
So the Cochin factory delivers to the basic power quality markets in the medium voltage AC grids. This is our bread and butter customers across the globe, the OEM customers. The factory that we are building in Sangli is a global factory. We serve more than 100 grids in the world. With the amount of HVDC and fax contracts coming across the world, especially being announced in Europe, US, and Australia, we believe the entire factory shall be booked for the HVDC and fax market for a global scale.
Okay, Mr. Pandian, end of FY25, order book was at close to 750 crore. Where does it stand at currently? So given that order book, what is the kind of gestation period, and over how many quarters will you go ahead and execute the current order book?
So the order book is increasing on a daily basis. So we have only good news coming in the next quarter results as and when it turns up. What we are
tentative, or if you could give us a ballpark figure of how much it's increased by?
It is increasing at a good pace. I don't know. I'm allowed to talk about the numbers on a compliance standpoint. I'm sorry, we are a newly listed company. However, I can only reach a healthy rate of growth. We are seeing that we will take a lot more HVDC orders coming in the H2 of this year. That's where we are seeing a larger focus.
If not a specific order book value, can you help us with maybe a pipeline then for, a quality power for Meru, and what has been your historical strike rate?
So we've already declared that we anticipate another 500 crores of minimum order book coming in this year, which puts our new order book at about 1250 crores for the year. And the revenue guidance is already between 700 and 800 crores. We believe we should have some positive surprises there also. We also believe a lot more in inorganic growth. We are looking at options in that region also. So we are busy at this moment building our own pipeline of orders, our factories, and also looking at other opportunities.
Have you zeroed in on any acquisition targets? What will be the likely size of the acquisition, and what will be the target, the targeted entity? What will be the peak revenue potential that you envisage there?
At this moment, we are talking to multiple opportunities. We look at culture fit, technology, and price. Eventually, price is also important. As and when we close something, I think we will inform the markets.
Well, sir, I'd also like to understand from you. So 210 crores of cash on books. You're also spending a lot on, your capex plans as well, and you're also eyeing some acquisitions. So overall, how do you expect to fund all of this?
We believe we are still a promoter-driven company. We, as a family, we own more than 74%, almost close to 74% of the company. We believe as and when the cash is called for, the promoters will put in a soft loan into the company that can fund the initiatives. So we are also delivering more than 100 crores of PAT last year. So as our revenue grows, so will our PAT and the free cash that is generated. We have also focused on capital allocation. We have not used the PAT and the free cash being generated to deliver a capex. So the capex is being already funded by a promoter soft loan. So the company's free cash is all for growth.
Okay, thank you so much, Mr. Pandian, for joining us. It's a very brief conversation today, but we hope to get you on the channel once again for a more detailed conversation post your Q1 results. But with that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.